Who is Paul Tudor Jones, and why should we care what he has to say? Paul Tudor Jones, or as many in the finance circles call him PTJ, recently went on a CNBC interview and said, and I quote, "All roads lead to inflation." Today, we're going to break this all down. We're going to talk about who Paul Tudor Jones is, why we should even care about what he has to say, and why he came to the conclusion that all roads lead to inflation. And then, of course, last but not least, we're going to talk about what you and I should be doing to protect our investments from said inflation if we believe that PTJ is correct. So without further ado, let's dive in. What's up, everyone? This is Brandon from Wealth Potion, where we discuss money, the economy, all in an effort to help you build and maintain your wealth. And today we're talking about inflation once again, but we're not just going to be riffing on our own about inflation. We're going to look at one of the most well-respected investors in the hedge fund industry, and that is Paul Tudor Jones, or PTJ as he's often called in finance circles. Who is Paul Tudor Jones? He is an investor. He's estimated to be worth about $8 billion, and he built most of his wealth through Tudor Investment Corporation, which is his hedge fund. But what's more important is that he basically pioneered the modern hedge fund industry. What does that mean? Prior to 1980 or so, when Tudor Investment Group was founded, most investors looked at stocks, individual companies. They had very focused investment theses around where they should invest their money. Paul Tudor Jones took a different approach. He basically started what's now referred to as macro investing by looking at macroeconomic trends, what's going on in the entire world, the global financial system, and then betting not just on individual stocks, but looking across stocks, bonds, currencies, commodities to bet on some of these hypotheses playing out. And one of his most famous bets was during 1987, where there was a massive stock market crash of, I believe, over 20% in a single day. So imagine the entire stock market crashing 20% in a day. Paul Tudor Jones and his fund predicted this crash, and they put on a huge short position, basically predicting that the stock market would tank, and they made out like bandits. They, I believe that year, made over 125% return in a year where there was a massive stock market crash. Needless to say, this is one of the many ways that Paul Tudor Jones has earned this recognition and reputation in the industry as one of the most legendary hedge fund investors. So when he goes on CNBC and talks about his thoughts on the economy, a lot of people tend to listen. Now let's talk about what he actually said. As I mentioned, he said all roads lead to inflation. What exactly did he mean by that? And why does it sound similar to the Wealth Potion newsletter where I said inflation is inevitable? Well, what he's referring to here is in respect to the US government's federal debt. The federal debt has grown exponentially. It has been going up and up and up. And this is not a partisan political issue. It grew under Trump's presidency and it grew under Biden's presidency. I'm recording this right before the US election, and I'll tell you, whoever wins the presidency, whether it's a Trump White House or a Harris White House, the debt is likely going to keep increasing. Okay, so why is that a problem? Well, it's not a problem in and of itself. I mean, the debt has been growing and growing, and it hasn't really caused problems. What it does, though, is it creates risk. Let's say there were another pandemic, or there was a new war. Let's say China invaded Taiwan, or some foreign nation attacked the United States directly. In order to defend itself, the United States would need to fund that war. They would need to potentially print money, or if it was a pandemic, they'd need to send out aid and help businesses and individuals. That would require the US to take on more debt. And as the US takes on more and more debt, the interest payments on that debt goes higher and higher. And as we've discussed in many videos in the past, the interest rates in the United States are at some of the highest levels they've been in decades. So these two things kind of coincide. We have a US government that's in a lot of debt and growing, and we have interest rates that are historically very high. Just to throw some numbers out there so you can get a sense of the scale here, the US government has more than $34 trillion in debt. A trillion is a million millions. It's a lot of money. Furthermore, the interest payments on that debt are more than $1 trillion per year at the current interest rate levels. Or to put it another way, to really highlight the problem here, is the interest payments are now 3% of total US GDP. So if we took all production in the United States, the entire economy for the year, 3% of that would be going to pay down the interest. And of course, the US government doesn't get all of that in terms of taxes. They get a percentage of GDP as taxes, and then they can pay down the debt. So while it hasn't caused any physical problems in the economy yet, you can think of it as an elephant in the room. An elephant that is growing bigger and bigger by the second that no one has really physically addressed. And that is where Paul Tudor Jones's thesis comes into play. He is operating under the assumption that the US government can and should bring down that debt. And he is basically saying that there's only one realistic option, which is inflation. But first, let's back up. What are all of the options? Well, one option would be to raise taxes. The US government could raise taxes substantially on whether it's the higher class income earners, on capital gains, on corporations. And keep in mind, when Trump was president, he just cut taxes in many ways. And so one of the options would be to let those tax cuts expire. And in the full interview, if you want to check it out, I will link it in the comments. Paul Tudor Jones kind of walks through that and says, okay, yeah, if we let the Trump tax cuts expire, that's going to get us about $300 billion, I think he says. But he basically comes to the conclusion that even if you raise taxes and even if you cut spending, which are both very unlikely, it's not going to get the debt to a manageable level. And so he arrives at the conclusion, which is that the government will have to inflate away its debt. In fact, he goes on to say that historically speaking, every civilization has inflated away their debt. That has been the playbook for managing the debt. To understand exactly how this works, I talked about this in a recent video, but to quickly recap, let's say I borrow $10,000 from you at a 2% interest rate. So in 1 year, I will pay you back $10,200. If inflation is 3% that year, I'm going to be paying you back $10,200 that are worth less than the $10,000 that I borrowed from you. That's what it means to inflate away the debt. So if you play that out over trillions of dollars and over many, many years, the US government can essentially reduce the real value of the debt. It's still $34 trillion, but they can make it $34 trillion that are worth less than today's dollars. I know this is a bit of a mind F of a concept, and we will do many more videos about this, but that's what Paul Tudor Jones is referring to. Now, of course, there is one other option that Paul Tudor Jones doesn't really talk about in this interview, which I think is important to consider, which is, what if the government doesn't care about the debt? What if they just keep increasing the debt and don't let anything happen? Again, it goes back to the risks, in my opinion. Nothing bad will necessarily happen, but it could put the US economy and geopolitically in a very fragile state. And the US has enemies around the world, whether that's China, Russia, the Middle East, etc. And when the US is in a fragile position, that does increase the likelihood of an enemy of the United States taking some sort of action while the United States is on an off footing. Because again, just to use the example of war, the US would find it harder to fund that war with this extremely high level of debt. All right, so that was a breakdown of what he means. Let's assume that we agree with Paul Tudor Jones here, that we think inflation is coming. What should we do with our investments? All right, so from here on, this is not financial advice, but let's listen to exactly what Paul Tudor Jones said. He says, and I'm slightly paraphrasing, but I'd say this is perfectly accurate. He says, I'm long gold, I'm long Bitcoin, I'm long commodities, I'm long the NASDAQ, and I'm owning zero fixed income. So I'll break down each of those 5 things and why he thinks those are good inflation hedges. Gold has been an inflation hedge for thousands of years. It's a traditional inflation hedge because as dollars lose value, gold maintains its value, largely because it's hard to produce more gold. It's a rare mineral, and that's why many cultures use it as jewelry. Bitcoin increases in value with inflation because it's kind of seen by many as digital gold. It also has a fixed supply. You cannot create more than 21 million Bitcoin. And as I've discussed in a previous video, Bitcoin was created by Satoshi Nakamoto as a protest against government money printing. So the ethos of Bitcoin is very much anti-inflation. The NASDAQ, this is a bit of a trippier one, but basically the NASDAQ is full of tech stocks and high growth companies, which tend to do well in the face of inflation because they are growing faster than inflation can reduce the value of dollars. And last but not least, he mentions that he's long commodities because, again, commodities tend to increase in price as the dollar loses value over time. The last one, though, is very important. He says he owns zero fixed income. Fixed income means bonds, and that's not just government bonds, but any kind of bonds. Why is that? Because the way bonds work is if I buy a bond, I will get paid a coupon in dollars every year or every 6 months, depending on the bond. But because I'm being paid in dollars and those dollars are losing value over time, Paul Tudor Jones believes that that is not a good investment for your money. So again, not financial advice. This is what Paul Tudor Jones is saying. I tend to agree with a lot of what Paul Tudor Jones is saying, but that is his thesis. Hopefully this was helpful. Again, whether you agree with Paul Tudor Jones here or not, whether you think inflation is coming or not, hopefully this video helped you understand what Paul Tudor Jones was referencing when you go watch this interview, and hopefully it highlights the importance of macroeconomics. I mean, PTJ is a perfect example. He's built his reputation and an $8 billion net worth by understanding macroeconomics and investing based on those assumptions and hunches. And I'm not saying you need to become a billionaire or that you will become a billionaire, but I think that understanding the global economy and the financial system will give you an edge, and it will help you build and maintain your wealth. And that's ultimately why I created Wealth Potion. So thanks for watching. Let me know if you have any feedback, questions, ideas. If you like this video, highly appreciate it if you like and subscribe, and I will see you next time. Thanks.